Hello, and welcome to Portfolio Matters Share Talk. In today's episode, we will be discussing the UK listed oil and gas E&P i3 Energy, which has assets in the North Sea, but in the past couple of years has put together a portfolio of oil and gas producing assets in Western Canada and is now profitable. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Tell us about i3 Energy, Keith.
Thank you, Richard. Okay, so i3 Energy has been around for a while, actually, and it has a couple of North Sea fields that it has been trying to develop for quite a while now. And essentially, the share price, as you will see, was going nowhere and drifting off as they tried to get the Liberator and Serenity fields developed and essentially have so far failed. But then during lockdown, they bought some Western Canadian assets on the cheap. Some of them they bought essentially out of administration. So they bought the bonds at 20 cents on the dollar, gaining control of the company. And they're been very dynamic in putting together a portfolio of Western Canadian assets, which is growing. And by the end of this year, certainly in 2022, they're aiming to have production of about 20,000 barrels a day. So they're actually a mid-size oil and gas producer. So the share price has been actually rising quite quickly over the past few months and is around 13.6p, giving them a market cap of 150 million. They've got a little debt of about 12 million, giving them an enterprise value of 162 million. Now, all the historic numbers are going to be way off because the last acquisition, the Cenovus acquisition, essentially doubles the size of their Western Canadian assets. And that was completed in August after the last interims. So one of the problems we have doing this share talk is that all the financials are essentially out of date. And we've had to make quite a lot of assumptions in our fair value calculation. And Stockopedia, which I actually pay for, it puts it on a dividend yield of 454%. And a P ratio of 0.1, both of which are wrong, essentially. So our calculation may be off, but it's not as off as Stockopedia's, and they charge money for theirs.
Just commenting on the historical nature of the information. So if they're currently producing 20,000 barrels a day and the oil price is about 70, according to my maths, that equates to revenue of about $40 million a year, or 30 million pounds, whatever. So the numbers are really quite significantly different.
Yes, absolutely. But we will do our own fair value calculation or P ratio calculation at the end, Richard, sure. Which I will caveat now, and we'll go through more. But, I've had to make quite a lot of assumptions. But we will make the spreadsheet available on our Discord channel should anyone want to poke around with it. Okay, summary. Well, I like this company. It's got very dynamic management, and they have essentially taken advantage of the bottom of the oil cycle to pick up these Western Canadian assets dirt cheap. And all the assets they've picked up have been either from companies in difficulties and cash strapped, or companies which regarded them as peripheral to their core operations and were therefore not very interested in them and not investing in them. So they have got lots of drill targets, and they seem to be constantly doing stuff, and we like active management. And you feel that in analyzing the company, you're kind of always slightly behind where they are, in that they've been doing so much stuff that, they're constantly adding to the portfolio. So oil and gas prices are high. They're a producer with a growing portfolio, and they're promising to pay out 30% of the free cash flow. And as you'll see when we go through the calculation, the shares aren't expensive when just valued on the cash flow from the Western Canadian assets. And they also have the substantial North Sea assets, which, if they manage to get developed, would be transformational. And the Serenity field is a decent sized field. Okay, so this is the share price, and you can see that in the early days, you had a strong share price rise based on the prospects of the North Sea assets, and then had a frankly disappointing drilling campaign, and the shares have come right down, but have been drifting back up. And actually, they've come up a lot in the last year. Okay, so going through the history, right? So its listed life started in 2017 on AIM at 55p. Now, bear in mind, the current price is 13.6p. So anyone who invested in the early days has not had a good existence. Sorry, not had a good experience. Its main asset then was the Liberator field, and it aimed to bring that into production in Q1 2018. So in the 31st of January 2018, it raised 2.57 million for a placing at 30p, and announced that it was in advanced farm out negotiations on Liberator, which would leave it with 67% of the company. And then in June 2018, now bear in mind, we're already past what it says it is aiming to be in production by Q1 2018, announces that it's got in farm out negotiations that would see Liberator and an appraisal well on Liberator West funded. But then in September of that year, it announced that the joint venture partner had failed to give it assurances about the money, and essentially it's fallen through. And when we now talk about the status of the North Sea assets of i3, it would seem to me to be that they are currently in a very similar situation, in that they have agreed the farm out of Liberator fields, and they're waiting for the financial assurances from their farm out partner. Okay, then in October 2018, they expand the stock tank oil initially in place estimate for Liberator to 314 million barrels, which is very substantial. And in January 2019, they announced they have contracted a rig for a 3-well campaign. In February 2019, they raised a £24 million junior loan note at 8% plus warrants to help fund the campaign. Then in March 2019, they do a placing at 37p. Then in September 2019, the drilling campaign gets underway, and it's disappointing. So their first well, C9, fails to penetrate the Captain Upper Sands channel as designed, and is plugged and abandoned. Now, the good news was the Serenity well found a field, and that is now a big part of the i3's portfolio, and one of the big hopes it has. And they have an estimated oil in place of 179 million barrels, P50. Then the second well on the Liberator field again fails to find the oil anticipated. In March 2020, it announced it contracted a rig for a further 2 wells in the North Sea on Serenity for an appraisal campaign. But then in March 2020, they start to acquire assets in Western Canada. So they announced the acquisition of Toscana Energy Income Corp for 2.8 million. And Toscana has 2P reserves of 4.65 million barrels and produces 1,000 barrels of oil a day. And in June, it announced a further acquisition, producing 10,000 barrels of oil a day for 60 million. So it's rapidly growing its Canadian portfolio. And in July, it was revealed that that asset was Gain Energy, which would add 11,000 barrels of oil equivalents a day and 69 million barrels of reserves. Then in August, it announced it agreed to sell Gain Energy's Saskatchewan portfolio. So i3 are concentrating on Alberta. They sell the Saskatchewan portfolio to Harvard Resources for 33 million, leaving them with a net acquisition cost of 28 million. And then they funded that with a £30 million placing at 5p. Now, bear in mind, it was listed at 55p. And in March 2021, it announced that it has allocated £1.16 million to pay its maiden dividend in Q1. And it farms its... So the rest of these are basically additions to its Canadian portfolio. So in May, it farms into the Clearwater development by agreeing to fund the first 2 wells to acquire 50% working interest at a cost of 1.3 million. And then later in May, it acquires an additional 49.5% of the company's South Simonette Canadian oil field for 4.8 million. And that will add daily production of 720 barrels of oil a day. And then in June, it announces the acquisition of Wapiti for 410. And it intends to reactivate 6 wells to raise production from the current 230 barrels of oil per day to 310 within the year. And actually, they've done that. And then in July, the transformative agreement to acquire Cenovus for 53.7 million. And that will add 4,800. Actually, I think that should be 8,400 barrels of oil equivalent per day, to be funded by a £40 million placing at 7p, and the market takes that well. Before we get going, a quick digression into the API scale of crude density. And API stands for American Petroleum Institute. Thank you to Richard for looking that up. And essentially, higher is better, higher is lighter. So rubbing alcohol has an API of 49, gasoline has an API of 45, light crude oil has an API above 31, and olive oil is 26. So light oil and gasoline, obviously much more liquid, lighter than olive oil, and then medium crude is lighter than coconut oil, and even heavy crude is lighter than water. Okay, so an overview of the company. Now, they're aiming to pay out 30% of free cash flow as biannual dividends. And they have 456 net production wells, over 409 acres. So they've got lots of low productivity wells, actually. So wells that are producing a few hundred barrels a day at most. And then they have the UK North Sea portfolio. Serenity has an estimated 197 million barrels of oil in place. And they are looking for a farm out partner for that. And as of the interims, they have green farm out terms, but then the farm out partner needs to provide assurances it's got the money. And as we've seen from the history, didn't happen last time. So it is currently aiming, the trouble is this is all rather out of date in the saying it's production, this is the interims of 9,000 barrels a day. Well, they're aiming for 18,700 next year after the Cenovus acquisition. So North Sea assets, this is Serenity, which was discovered in the drilling campaign in December 2019. It's got an API of 31.5, i.e. light, but really at the very lowest end of the light spectrum. Good porosity and estimated stock tank oil initially in place of 197 million barrels P50. So a good size field. And as of the interims, agreed in principle with farming partners for a Serenity appraisal well, but awaiting proof of financing commitments. And they're saying that if they can get Serenity in production, then that will be a transformative for the company. Liberator, well, the Liberator drilling campaign was rather disappointing, but they now have remapped the entire structure, and they now think that the oil has migrated to Minos High. So if you look at the table bottom left, you'll see they're estimating that Minos High has a very substantial oil reservoir, but they are looking for a farming partner. And the other thing to say is that these are quite close to the Blake field, which has a producing well. So infrastructure should not be difficult. You can plug these into the network. Okay, now onto the Western Canadian assets. And there's a lot here. And frankly, I'm not going to go through all these, because if you're interested, go and have a look at the presentation. There's the bottom line is they're doing a lot. If you listen to the CEO interviews, they've been working 24/7 on acquisitions, and then trying to organize the drilling of all these various assets. And they have a lot of high grade drilling targets because the previous owners, either these assets were peripheral, or frankly, they just didn't have the money to do them. So that's all very positive. And this is a map of where they are. So they're all in Alberta. They have Wapiti, which is shallow oil. And then Simonette, which they have increased their acreage. I think they now own 99% of the economic interest in those wells, having bought an extra 49.5%, as we saw earlier. Then they have the Clearwater, and their recent Cenovus acquisition adds lands which overlap with theirs. So the yellow areas are the Cenovus lands, the orange are the I3 lands, and the red are shared lands, so where they had percentages of the same land. So there are significant synergies involved in bringing those assets together under one roof. So this map shows you a more granular picture of the Cenovus acquisition, and just reiterates how there's a lot of overlap. Now, they have bought the Cenovus assets at a price of around $6,400 per barrel of production. And to put that in perspective, at $75 per barrel, a well producing 1 barrel per day will generate $27,000 per annum. So even on 1 year's production, that looks like a decent deal, frankly. and they're saying break even. I mean, my problem with it, all these break even numbers is they're never true, frankly. They're always, they manage to pare down all the costs to get the most flattering number they can. And as we'll see, that just doesn't work, that $11 a barrel. I think, anyway. So these are all the pipelines which they can now share between themselves. So there's quite a lot of synergy there. And these show the effect of the acquisition on working interest in developed and undeveloped wells. So this table shows the effect of the Cenovus acquisition, and you can see in the second half, you're going to have basically more than doubled the net operating interest of the company, and production will have more than doubled, and they'll have 2.5 times the reserves, etc., etc. But all these incremental acquisitions are adding production and value. And so one of the investment propositions of i3 is that they will find a way of keep on doing this. And as we've seen with other oil companies listed in London, such as Jadestone Petroleum, there are various companies who just want to get out of the oil sector and are essentially willing to just give these assets away. So perhaps there's the opportunity for them to do that. Although, frankly, as the oil price rise, you suspect that the prices of acquisitions will rise with them. Okay, so H1 financial review, which frankly, I'm going to skip over because it's all out of date now, because the Cenovus acquisition occurred in August. So, since then it's more than double. But, the things to take away is that even on the first half, it was, had decent revenue, 26.5 million, and was generating cash flow from operations of about 8 million. But then it's, spent money on acquisitions, etc. But it did put aside money for a dividend as a statement of intent. Now, the thing you should be aware of is these wells decline at a decent clip. So the decline rate of these wells is between 12 and 15% per annum. So just to keep production at a steady level, you're going to have to constantly invest in new wells or well interventions. And in doing my calculation, I have used this figure of $5,500 per barrel of oil equivalent of production as the figure it will cost them to offset natural decline. So you can that figure can either be through well interventions and drilling new wells, or from buying production from other companies. And they are saying that their net operating income, and bear in mind, net operating income is a figure that can be manipulated. Depends what you cut out and you define as operating. But you can see that they are showing that in the first half, net operating income would have been 12.5 million. And then in the second half, it'd be 51.5. And frankly, that is all before the big spike in oil and gas prices. So that is likely to be very substantially higher. But they do hedge. Now, these hedging numbers are from the interims. And what is interesting is that although they hedge about 50% of their production, their hedges are quite short term. So you'll see that these are figures as of the 30th of June, that they've hedged 50% of July's production, but then August, they've only hedged a third, and then 25% for the next 4 months, etc. So they're not that exposed. They definitely will have lost money on their hedges as the oil price has shot up, but their hedges are quite short term. And these are the contracts they've declared in the interims. You see that, they're 3 to 6 months, and they had lost money on them, lost 2.7 million on them thus far. Okay, so in order to do a calculation, we need to know what the gas price in Alberta is going to be. Now, this is the gas price that we'll be able to find, and it only goes to July. Now, if you compare that with the US gas price, you will see, for example, this strong spike of 50% in late 2018 is entirely absent in the gas price in Alberta. And that suggests that the Alberta gas price is not well connected to US gas prices and therefore to global markets. So I've therefore been quite conservative in my assumption for the Canadian gas price, and I have assumed 3.5 Canadian dollars per gigajoule, and that is about there, slightly above its position in July. But as you can see from this chart, since then, the gas price in the US has absolutely shot through the roof. And the question is, has the gas price in Alberta followed it? Okay, so I'm afraid this is going to be a very rough calculation, but I will put the spreadsheet I used onto our Discord channel. And if anyone wants to have a dig around, then please feel free. So we're going to assume uptime 98%, gas production of 60%, oil production of 40%. Hedging losses, I'm just going to put in as 5%, just a 5% loss, because they will not be participating in this rise, and that will have cost them money. And the decline rate, we're going to put in at 15%, i.e. the bigger figure of the range, and we're going to use their number that's going to cost them $5,500 per barrel of oil equivalent to offset that decline rate. The Canadian gas price is about $17 per barrel of oil equivalent, and we're going to use an oil price of $75 a barrel. And one thing you should also be aware of is they have various royalties they pay, and those are gross revenue royalties. So they come straight out of the top line, and that's 10%. Assuming 2022 production, will be 18,700 barrels of oil per day. Now they're aiming to get to 20, but we're going to assume 18,700. And then an increase in admin costs of 50% and a doubling of depreciation and depletion. And if we do all that, then just valuing i3 on the cash flows from the Canadian assets alone gives you a P ratio of about 3.6. So that looks pretty good value, given that we have put no value at all on the North Sea assets, and Liberators is decent. And Serenity is a decently sized field, and the Minos High field in the Liberator area has very substantial potential oil in place if they can find a farm-in partner. These are the historic numbers, but once again, these historic numbers are largely irrelevant. And frankly, these are from Stockopedia. And given they're putting on a forward dividend yield of 424%, which we know to be wrong, I'd put low confidence in these figures, frankly. Okay, moving on to positives. Well, it seems to be a very dynamic management in that the North Sea assets were going nowhere. So they have then essentially reimagined the company by buying loads of cheap assets in Western Canada. And they bought them right at the bottom of the cycle last year during COVID outbreak, and then have been adding to them this year. They're aiming to grow production to 20,000 barrels or more in 2022. And because those assets were neglected, they have lots of decent drilling opportunities. And if they can get a farm in the North Sea, and as the oil price rises, you would hope the probability that they'll manage to do that will also be rising, then the development of the Liberator field and potentially Minos High would be absolutely transformative. And obviously, oil and gas prices are rising. Gas prices in Europe are absolutely astonishing, although you feel that were they to get Serenity and Liberator online, gas prices are likely to come down from their highs by then. And as we've seen, by my calculation, the shares are not expensive, and they are committed to a dividend policy of 30% of free cash flow. So that's good. But there are significant negatives in that largely we just don't know. We're making quite a lot of guesses about the financials because the Cenovus deal went through after the interims, and we have no idea what the actual figures for operating costs, for admin, etc., will be. Also, we don't know what the figures. Everything we get on Portfolio Matters is largely free, I'm afraid. So the free resources we have managed to find for Alberta gas prices are as of July, and obviously the gas price has spiked very strongly since then, and I'm not sure what has happened to the Alberta gas price and how well the Alberta gas price reflects the moves in international markets. If anyone knows better, please get in touch and we will issue a clarification in the description of the video. Also, the Western Canadian assets have a decent decline rate, so you're going to need to constantly keep on drilling or keep on adding production from by buying it in order to keep production up. And the Serenity and Liberator, essentially we don't know what the farming terms will be, so how much i3 will keep of those assets. And obviously, the previous drilling campaigns, the exploration drilling campaigns, did not go well. So, how much value can you put on Minos High? And the Serenity wells, it all depends on whether they can get the farming partner and whether Serenity flows as well as they hope. So, in summary, actually, I like this. And I bought a decent amount, and I'm going to keep on adding to it. I think there's very dynamic management. And yeah, Richard, your thoughts?
Yeah, great. Thank you very much, Keith. Very detailed presentation as ever, and with the caveats of the uncertainty of the figures because of the recent very significant change to the operating business of the Cenovus acquisition. So I think oil companies are at a very interesting point in their life cycle at the moment. We believe that there is a world energy shortage, and that's what's pushing up the prices of gas and oil and coal. And substitutes for those are either slow to come on because they come on piecemeal, i.e. wind or solar, or if you want to build a nuclear power station, it'll take you 5 or 10 years from the idea to having it actually generate any electricity. So if the oil price were to halve, then i3 Energy would be a poor investment. If the oil price were to double, then it would be a splendid investment.
Yeah.
And I think that the view of an oil company like this, which clearly has quite a lot going for it operationally, and it's a relatively low cost producer, the value of these businesses is really dependent on what is going to happen to the oil price over the next few years. And if people come to believe that the oil price is currently at a low and is going to go up, but the current price is basically sustainable, then these businesses will over time become more and more highly sought after, more and more valuable. And if the oil price goes up because of what we perceive to be the energy shortage, then that value will increase. The negative, the corollary of that, of course, is as energy prices increase, the world is more likely to slow down, the economy is more likely to slow down, and we're more likely to go into recession, correcting the shortage of energy. So I think that this is a good company. I agree with you. I think it looks like it's a good investment. It has a dividend yield, but fundamentally your investment thesis has to be based on what you think is going to happen to the world's demand for energy over the next 5 years, and in consequence, the prices of oil and gas.
Absolutely, Rich. But regular viewers will know that I am super bullish on oil. And
I am as well, because I think that it doesn't really matter. The deficit that we appear to have at the moment seems to be so large that it's hard to conceive that we're going to suddenly find we're back in surplus. And particularly as the developing world is becoming more and more energy intensive, India's demand for energy and so forth.
Yeah, and the thing you make a very good point about high oil prices and high energy prices driving the economy back into recession. And I'm very well aware of that. But if you look at the oil price where it is now, it's about mid-range. Now, the gas prices, on the other hand, are absolutely astonishing. And they certainly will be driving some businesses out of business now. Yeah. And that's a real danger. Now, the oil price, you can't just buy and hold these companies. When the oil price goes too high, it will suck demand out of the economy and it will kill the world economy. So the aim is always to buy these companies when the oil price is moving up, preferably right at the bottom of the cycle, and then sell them towards the top before.
A really good point, Keith, and that is the investment strategy for these businesses.
Yeah, absolutely.
Yeah. Well, thank you very much, Keith. That was a really interesting presentation.
Great. Thank you, Richard. And thank you all for watching. Please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.